is up YouTube? My name is Aditya and welcome to our channel Varchaswa Trading. In this video, we'll be discussing about Wyckoff accumulation and distribution phases using only a daily time frame candlestick. Yes, this might sound a little insane, but we try to understand how a daily candlestick every day forms the accumulation phases, distribution phases, markup phases, and all of those things. So let's just jump into it. So here we go, guys. Let's try to understand how these Wyckoff phases looks like, and if you're completely new, let me name the terms for you. So Wyckoff has accumulation, reaccumulation, distribution, and redistribution. And in between these phases, you will see some markups and markdowns. So how does it look like with a visual representation? So if we have this, let's say if we go on to the charts and if we identify a consolidation, that could be an accumulation right here. Okay, so if the price is consolidating, you can identify this to be an accumulation or a distribution, and then the prices move higher. Now what's happening inside this range? The prices are getting accumulated, the orders are getting accumulated. The institutions, what they're trying to do is, people who put their stop losses below here as buy orders. Okay, so these buy orders, or these sell orders will eventually be the buy orders for these institutions. Okay, so as these retailers are buying around this point, what they are doing here is they are putting stop losses below this, and these stop losses are the sell orders, and that's how these sell orders become buy orders for these institutions. So it's an accumulation. Now after this, the price moves higher. Now what do we call this? We call this as a markup. So this is what we call as an accumulation, this is what we call as a markup. Now as the price already moves around here, and what it will do around this point is it can actually reverse back down or continue its trend to the upside. Now if we see a continuation, obviously we'll have to call this as a reaccumulation. Okay, this will be a reaccumulation, and as the prices moves ahead from here, this will be another markup. Okay, so if you can identify these things, if you can identify what's happening inside a range, you can actually understand where the prices are supposed to go, if it's supposed to go lower or if it's supposed to go higher. Now what happens as the price moves higher around this point? This is where what we can see is a distribution, and the price could simply fall lower. So if the price falls lower around this point, we'll have to call this as a markdown. And as the price falls lower here, we may see another redistribution, and the prices can continue lower. So this is how the Wyckoff cycle works around. This is how the Wyckoff cycle works around. And we can have a simple visual representation of this on daily time frame candlesticks, and we can use this concept to our advantage. So let me make you try to understand this. Let's say we have a bullish candle. Okay, let's say we have a bullish candle right here, and we have wicks above it. Obviously we do have wicks above it, right? On daily time frame, you will see most of the candles looking like this. So this wick lower, okay, this and this wick higher is where all the accumulation and distribution takes place, and this phase is what we call a markup or a markdown. All right, so as we all know that this is the opening of the price, and this is the closing of the price. So this is the open, this is the close, and we have this as the low and this as the high. So what happens? Let's say the market opens at around 9:15. Okay, the market opens at around 9:15. So this is where the prices are. Let's say this is 100 rupees. Okay, this is 100 rupees, and this is the opening price. So I'm representing this point. Okay, and this is at around 9:15. Now what happens? Most of the time, as you see in the markets will go higher, and then they will completely reverse back down. The markets will go higher, and then they will completely reverse back down. The markets will go lower, and they will completely reverse back up. Now what's happening here? Let's try to understand that, because if you can understand these points, you will be able to take some good and nice reversal trades or a trend continuation trades if you can apply these concepts with what you are actually doing as of now. So let's say the price opens at around 100 rupees and this is the opening price. The the market first goes below. Okay, now let's say I have a bullish bias. Let's say I have a bullish bias and it's around 9:15. Now what happens when I have a bullish bias? At this point, just imagine the number of people who are wishing to take a sell position right here. The number of people who are wishing to take a sell position right here, just try to understand that. Okay, as soon as the price falls lower, everybody is ready to sell this. Everybody is ready to sell this. Now, this selling is creating, understand this selling is creating buy orders for these institutions. Okay, just try to understand this. Let's say, okay, if I simply tell you this is liquidity, this is liquidity, it's not an of it doesn't really mean that the liquidity only stays above these highs or these lows. Okay, you can generate liquidity as the price is moving. So at this point everybody is selling, and these sellers or these sell orders are the buy orders for these guys. So these guys are buying from these sellers, so they have liquidity now. Their orders are filled, their purpose is filled. They had a lot of huge quantities, and what they do now is they push the prices higher. They push the prices higher like this, and this is where all the accumulation was done. I'll show you n number of examples every day. All of these things occur. If you can understand this thing, you will get a hack to understand where the markets are supposed to move. Okay, so now let's try to understand this once again. So the price will move lower. Okay, these sell orders will be the buy orders for the institutions, and what they'll do now is they'll push the price higher. So this is what, this may not look like a consolidation, but this will definitely look like a wick on the daily time frame candle. This will look like a wick on the daily time frame candle. So this is your accumulation, guys. This is your accumulation. This is your accumulation right here. And if you can enter around this accumulation, I'm not saying that you're supposed to get an entry around this point, you're supposed to get an entry around this point, you're supposed to get an entry around this point. No, but here we are just trying to understand how the prices are supposed to move higher. So if the prices are supposed to move higher on a daily time frame candlestick or on a single day, it has to first go below and then push higher. Okay, it has to first go below and then push higher. So if this is my accumulation, I'll mark this as an accumulation as well. If this is an accumulation, this up move is a markup. This up move is a markup, and you might see the price moving higher, coming lower, and then again pushing higher. So this fall down, okay, this fall down is a reaccumulation of prices, because these guys who had a sell bias, what they're doing here is they are pushing, they are expecting the prices to go lower, and they are selling as much as they can. Who are the buyers? The institution are the buyers, and what they do next is they buy from these sellers and they fulfill the purpose and again push the prices higher. So this becomes what, guys? I'll keep some space here for you all to have a better understanding. So this becomes what? This becomes a reaccumulation right here. This becomes a reaccumulation right here, and the prices moves higher. So this now becomes my markup. This now becomes my markup. So we had an initial markup around this point, okay, and this is how the price moved, this is how the price moved, and this is where we are now. By the end of the day, what you will see is that the price will go a little higher and then close around this point. Now this is where the distribution takes place. This is where the distribution takes place. I hope you guys are getting a better understanding of how these things work on the daily time frame chart. All right, so now if I come here and if I simply show this to you, just have a look, guys. Every candle that you see on daily time frame has a wick above. Now just imagine if you are somebody who can sell around this point. So this is the opening price, right? This is the opening price, and the price runs away from the opening price most of the time. Now if you know the correct direction, if you can enter near the opening price as many times as you can, you have a very high probability of pushing the prices in your direction or having a good risk reward ratio of 1:3, 1:4, 1:5 sometimes. right? Obviously that's not an easy task, guys. That's not an easy task. Trading is pretty tough, and you need to understand, you need to do these things day in, day out. So now let's say this is the opening price, right? The price went above. That's what, that distribution for us, and then the price falls lower. This fall down is the markdown. If the price goes up, that's a markup. If the price goes down, that's a markdown. And this is where what we have is the close of the candle. Okay, and then we have the wick. So if this is close, this is wick, this is a little accumulation that took place. Now again, if you see this, sorry, yeah, the market, this candle opened right here. So this is the opening price, this is the accumulation, price goes up, this is the close of the candle, this is a little distribution that took place. Now see this, the price went higher, this is the accumulation, price went higher, came back down, closed near the opening price. Now again here, look at this, this is the opening price, accumulation, the price spiked up. So obviously these opportunities on intraday basis are really good for us to have a good risk reward ratio. At least 1:2 is something that I can achieve, or I can take on a regular basis, right? And then if you can apply position sizing to it, then that becomes a really good thing. Now look at this candle, the price went lower, came back up around this area, this is accumulation, the price moves higher, this is markup, and this is your distribution, the price closes here. So this is how I have a view on which direction I'm supposed to take a trade, and this occurs each day, guys. This occurs almost every day. Look at this, just look at these candles. Now I know you guys must be thinking how you're supposed to use this on the 5-minute time frame. So let's have a look here. Now it's very important for you all to understand that this is not a strategy, this is an understanding of the market. This is a perspective that you need to develop to have a better direction for your trades. It's very important. So if I put these session breaks here, and this is 5 minutes, this is a 5-minute chart. Okay, so this is the opening price. This is the opening price. Now I'm not saying that the price goes higher, it comes here, you sell a breakdown as the price goes below the opening of this candle. No, that's not true. That's not how you're supposed to take trades. What you need to understand is if the price is hunting any of the previous liquidity. Okay, so again, I'm not making you understand a setup around this point, but I'm just making you understand how the price initially in the morning goes up and then falls lower. Okay, so it will most of the time fake you out. It will induce all the sellers and then push the prices higher. And if you see this, look here, most of the time the price will fall lower and then move up. Most of the time the price will fall lower and then suddenly move up. So this is what you need to understand. Obviously in some cases it won't happen, but if you have a proper bias, if you can understand how these things work and apply it to your setup, you have a very high chance of taking some high probability trades every day. Okay, you have some very high chance. So if you see this is the opening price, the price had to go above, and this is where all the breakout traders come in. They tried, see, this candle did not marked any wick initially in the morning, so it had to go above for some distribution and then push the prices lower. So this was definitely one of the best trades that anyone could take. If there is no distribution early in the morning, the prices comes back around 1:30 in the afternoon and then pushes lower. So this is how you need to have some open-minded understanding of how the prices move. Now even if you see this is where the price first went lower and then suddenly pushed higher. Okay, now there are again cases where the price pushed up and then simply pushes higher, but you will see a wick around those areas. However, I do not prefer to take such trades without an understanding of where the prices are going. So if I see an up move, I won't simply start shorting this. Okay, if I have a long bias, I need to understand where the prices are supposed to move first. Now if you see this is where the price simply fell lower, and look at the up move that you get. Okay, so this is your opening price, and all of this, guys, is your accumulation. Now I'm not saying that you cannot enter your trades around this point. Obviously we can do that, and this is what we need to learn. This is how these things work, and to help you guys make this use as a trading setup wait for the part 2 that will be uploaded very soon, and in that video we'll be making you understand how you can take trades using this concept and how you can understand what should be your bias. Thank you for watching the video till the end, guys. If you find the video insightful, make sure to hit the like button, share the video as much as you can, and subscribe to the channel. And if you wish to connect with us, the link to our Instagram profile is mentioned in the description box down below. So you can reach out to us any point of time with your queries, and make sure to let us know what topics do you want me to cover in the next coming videos. Thank you so much, guys. Enjoy.